Making passive income with dividends is not hard, everyone can do it. But making passive income from dividends without risk should be the goal of every single investor. If you invest and have a high risk of capital loss, then you're not investing the proper way. The key to every single investment is doing the proper analysis. But how do you do it? Stay tuned and find out. In this video, we'll cover the most secure dividend stocks in the world and we will explain with real examples how to make a quick and easy analysis. The basis to every successful investment is to have a structural analysis which is made before the investment has happened. In this video, I, Bobby the Market Watcher, will show you the best analysis for dividends which is used by the greatest investors in the world. As one of my greatest mentors has always said, the great Warren Buffett, rule number 1 of investing is never lose money, while rule number 2 is never forget rule number 1. Before we begin, I want to share with you that this knowledge has taken me an enormous amount of time to learn it, and I've spent hundreds of hours on the topic, and now I am going to share with you everything I know which has been learned from the greatest investors in the world. So guys, let's begin. The most secure dividend stocks most of the times are stocks which have paid dividends for multiple years straight without any interruptions. It is quite obvious if we have two companies and one company has been paying out dividends for 1, 2 or 3 years, and next to it we have a company that has been paying out dividends for 10, 20, 30 years or more. The more secure investment from a historical perspective is the one with more history of dividend payouts. But at the end of the day, looking only at the number of years a dividend has been paid out does not give us any indication on whether the current state of these dividend payments is in good shape. It is possible that from this point onwards the company profits have started to fall and sooner rather than later the dividend payouts would be stopped or slashed lower. In order to make a good dividend analysis, we must look at the historical years. We must also look at the current dividend compared to the historical average. For example, if the dividend has been paid out for 10 years and the average dividend yield for these 10 years has been 5%, but currently the yield is 8%, that means the stock price is low and the current dividend yield is very good compared to its average level. If the opposite occurs and the dividend is 2%, while the average level is 5% for the last 10 years, then the stock price is very high in relation to the dividend payments, and it is better to wait out the stock until the price drops and it comes back higher. Then the third thing we need to look at is the dividend payout ratio. The formula looks at what percentage are the dividends in relation to the net income. We take the total yearly amount of dividends paid out and divide it by the total net income per year. In general, there is no specific rule or level a company should exceed. Let's take an example. If a company is paying out $5 per year in dividends and it has a net income of $20 per year, that gives it a dividend payout ratio of 0.25, or in percentage terms, 25%. It really depends on the industry. In general, the dividend payout ratio should not exceed the 50% mark. This gives us enough certainty if the dividend would be cut, dropped or increased. If the payout ratio is above 75 or 80%, there is much bigger risk for drops or dividend cuts. For example, if the net income drops with 20%, then the ratio would become 1 or 100%, which means that the dividend payments are equal to 100% of the net income, which is by far not ideal, as it does not give any excess cash for the company, which it can use to grow or increase the dividend. The next thing we must look at is the dividend growth rate. As time passes, we want our dividends to slowly increase over time. This helps us beat out the inflation rate and also makes our investment more profitable. So let's make a recap on what we just learned.
First, we check for how long has the company paid out dividends. Then we check what is the historical average dividend yield, and we compare it with the current dividend yield. This shows us whether the company is over or undervalued in comparison with its dividend. Then we must check the security of the dividend, and for that we must look up the dividend payout ratio. It also tells us if the company can increase its dividend payments in the near to mid-term. And the fourth thing we look up is the long-term dividend growth rate. As I have already explained, we want the dividend to increase. Now that we know the steps, let's go through which companies have the longest history of paying out dividends. The two major dividend stock categories are the dividend aristocrats and the dividend kings. The dividend aristocrats are a group of stocks which all have been paying out dividends for more than 25 years without any stops. The dividend kings, on the other hand, are companies which have been paying out dividends for more than 50 plus years without any interruptions. The two groups consist of the most well-established businesses in the world. It is important though to say that usually these companies are very matured businesses which have very slow and methodical growth rates. Usually the gains from these stocks are not enormous, but they have proven themselves over time as the best investments. When we have a fast-growing company, most of the times it does not pay dividends because it uses its cash reserves and net income to grow the business. That would be much better for shareholders, and when looking at a mature and an established business, it is best for it to pay dividends because that is the main reason investors hold on to the certain shares of the business. In the next video, we can cover all major stocks which are included in the dividend aristocrats and dividend kings lists. We can go through them bit by bit. For now, let's take only one company and make an example of the 4-step dividend stock analysis. So let's analyze Coca-Cola. The company has started to pay a dividend in the late 1964, so for 58 years straight the company has not stopped paying dividends, and it has a deserving spot in the Dividend Kings list. So the history of the dividend is quite vast and secure. Now we must take a look at the historical dividend yield and compare it to the current levels. The current level of the dividend is around the average level for the last 50 years, around 3 to 3.5%. So from that perspective, the dividend yield is telling us that the stock is neither over or undervalued. It is close to its fair value. The third thing we need to analyze is the dividend payout ratio, for which we must take a look at the yearly paid dividends, which can be seen when taking a look at the cash flow statement. And then we need to take a look at the net income, which can be seen on the income statement. So during the last 12 months, the dividends that have been paid out by Coca-Cola have been $7.43 billion, while Coca-Cola's 12-month net income is $9.57 billion. When we divide the two, we come up with a 0.78 dividend payout ratio. This shows us that 78% of the net income is going to dividends, which is more than what we would like. But when it comes to Coca-Cola's industry, it is normal for the dividend payout ratio to be higher than 50. For example, Coca-Cola's main competitor, Pepsi, has paid out $9.97 billion worth of dividends over the last year, while its net income is $9.27 billion. This gives out a dividend payout ratio of 64%, which is better than Coca-Cola, and it shows us that if Pepsi wanted, they could increase the dividend more in comparison to Coca-Cola. It is always best to analyze 2 or 3 companies from the same sector. We should not analyze a tech company with a manufacturing company. Always compare apples to apples, not apples to bananas.
The last thing we need to check upon is the dividend growth rate,
so that we have it easier on ourselves and not check every single year by hand and calculate the dividend growth rate this way. We can just use a third-party software which calculates this for us. For example, a free tool is Guru Focus, and when checking upon the last 13 years of history of Coca-Cola's dividend growth rate, we can see that it averages 9.1% per year. So every year Coca-Cola on average increases its dividend payments by 9.1%, which is a very strong growth and it is well above the inflation level.
As you can see, it is very easy to do a proper dividend analysis if you use the framework I just described. Let me know in the comments down below if you want to learn more of these techniques which lower your risk and increase your returns.
If you are interested in learning more about economics, finance and investing, make sure to subscribe and hit the notification bell so that you won't miss out any of our upcoming videos. As always, I am Bobby, the Market Watcher, and I wish you a wonderful day and until next time.